Let's talk about risk and return, two concepts that dance together in the world of investing. If you're new to investing, you might be wondering why these two ideas are so crucial. Well, think of them as the yin and yang of your investment journey. Understanding them is key to making informed decisions and ultimately growing your wealth. So let's break it down in a way that's easy to digest. First off, what do we mean by risk? In the simplest terms, risk is the chance that you might lose money on your investment. It's that nagging feeling in the back of your mind when you hit buy on a stock. It's the uncertainty that comes with putting your hard-earned cash into something that could go up or down in value. But here's the kicker. Risk isn't inherently bad. In fact, it's a natural part of investing. Without risk, there wouldn't be any potential for reward. Now let's pivot to return. Return is the profit you make from your investment. It's the sweet reward you get for taking that leap of faith and investing your money. The relationship between risk and return is pretty straightforward. The higher the risk, the higher the potential return. Conversely, lower risk investments typically yield lower returns. It's like a seesaw. One side goes up, the other side goes down. Imagine you're at a carnival. You see a roller coaster that looks thrilling but a bit scary. That's your high-risk investment. The adrenaline rush of riding it could lead to a fantastic experience, or you might end up feeling queasy. On the other hand, there's a merry-go-round. It's safe, predictable, and you know exactly what to expect. That's your low-risk investment. It might not be as exciting, but you're pretty sure you'll enjoy the ride without any surprises. Now, let's dig a little deeper into the types of risks you might encounter. Market risk is one of the big ones. This is the risk that comes from the overall market moving up or down. Think of it as the tide that lifts all boats or sinks them. Then there's specific risk, which is tied to a particular company or industry. If you invest in a tech company and it launches a product that flops, that's specific risk. You could lose money even if the overall market is doing well. Another important concept is volatility. This refers to how much the price of an investment fluctuates over time. High volatility means the price can swing dramatically, while low volatility means it stays relatively stable. If you're someone who gets anxious watching stock prices bounce around, you might want to lean towards investments with lower volatility. But remember, lower volatility often comes with lower potential returns. So how do you navigate this landscape of risk and return? One of the best strategies is diversification. Think of it as not putting all your eggs in one basket. By spreading your investments across different asset classes, industries, and geographic regions, you can reduce your overall risk. If one investment takes a hit, others might perform well, balancing out your portfolio. It's like having a mixed bag of candy. Some pieces might be sour, but others are sweet, and together they create a satisfying treat. Now let's talk about your risk tolerance. This is a personal measure of how much risk you're willing to take on. It's influenced by your financial goals, your time horizon, and your emotional comfort with market fluctuations. If you're investing for retirement that's decades away, you might be more willing to take on higher risk because you have time to recover from any downturns. But if you're saving for a house in the next few years, you might want to play it safe with lower risk investments. Understanding your risk tolerance is crucial because it helps you build a portfolio that aligns with your comfort level. If you're too aggressive and invest in high-risk assets when you're not comfortable with it, you might panic during market downturns and sell at a loss. On the flip side, if you're too conservative, you might miss out on growth opportunities that could help you reach your financial goals faster. As you embark on your investment journey, it's also important to remember that risk and return are not static. The market is always changing, and so are the risks associated with different investments. Staying informed and regularly reviewing your portfolio can help you adapt to these changes. It's like being a captain of a ship. You need to adjust your sails based on the winds and currents to reach your destination. Now, let's address a common misconception, that investing is akin to gambling. While both involve risk, investing is fundamentally different. When you invest, you're buying a piece of a company or an asset that has the potential to grow over time. You're not just hoping for a lucky break. You're making informed decisions based on research and analysis. It's about understanding the fundamentals and having a strategy in place. So, how do you get started? Begin by educating yourself. Read books, follow financial news, and consider taking courses on investing. The more you know, the more confident you'll feel in making decisions. And remember, it's okay to start small. You don't need to invest a fortune right away. Start with what you can afford and gradually increase your investments as you become more comfortable. In conclusion, understanding risk and return is essential for anyone looking to invest. Embrace the fact that risk is a part of the game and learn to balance it with the potential for return. Diversify your investments, know your risk tolerance, and stay informed. Investing doesn't have to be intimidating. With a little knowledge and a willingness to learn, you can navigate the waters of risk and return with confidence. So, take a deep breath, trust the process, and enjoy the journey of growing your wealth. After all, investing is not just about the numbers. It's about building a future that aligns with your dreams and aspirations.